One of the questions I get quite a bit is, what makes more sense, FHA or conventional with 3% down options? We're going to dive into that a little bit more right now and show you that it really boils down to what's your credit score. Stay tuned. FHA 3.5% down or conventional 3% down, or maybe we push for conventional 5% down. What is the best option? Well, at first glance here, you're seeing 4.875% for FHA, all the way up to 5.125 for the conventional options, and then back down to 4.875% for conventional 5% down with a credit score of 740. I wanted to pop that one in there so you could see how important credit score really is when it comes to conventional mortgages. Not only does the credit score affect the interest rate, but it's also going to affect the overall mortgage insurance on a monthly basis that you're going to pay. One thing we want to note just right out of the gate is the upfront mortgage insurance premium to FHA that we're financing on top of our base loan amount. So we put our 3.5% down, and then FHA is going to tack on 1.75% back on top. So we're paying $5,066 on this loan in order to use FHA. Now, you don't pay that money out of pocket at closing, but you are certainly going to be paying for it at some point, and more than likely, it'll be coming out of your equity at the time of sale. The first thing I want to point you to with all these different options is the payment difference. So if we look up here in the top right-hand corner, we'll notice that conventional 3% down is the highest payment, essentially. The next lowest payment is going to be FHA with a savings of $60.61. 5% down with a payment savings of $87.50, and then a big whopping $190.42 with 5% down with a credit score of 740. Biggest benefit we have here with FHA versus conventional 3% down is FHA's payment is a little bit less expensive. The downside obviously being that we are financing that upfront mortgage insurance premium of, over $5,000. I think the biggest difference here that we can see is going from 3% conventional to 5% conventional. That extra 2% really saves us a lot. It saves us $55 a month on the mortgage insurance, which really adds up, guys. I mean, $55 a month. Think about that. If you were to take that and put that towards your principal payment each month, you're talking probably cutting 3 or 4 years off the mortgage just in doing that. So saving that extra 2% and putting that extra 2% down on a conventional mortgage is really, really going to help you. The next comparison I want to show you is the difference between a 700 credit score and a 740 and how much can change in between those numbers. Obviously here you're going to see that the interest rate is actually going to drop by 0.25%. If we go in here to more info, I want to show you the mortgage insurance drops another $60 a month for 40 points on your credit score. So the higher you can get that score, the better you are, not only again with the interest rate, but with the mortgage insurance itself. Where we are right now, 3.5% versus a 3% down conventional, you can do either. But realistically, if you can get the extra 2% for the down payment, it really, really makes sense to go ahead and push for that for a conventional mortgage, especially again with a credit score above 700. If you pay attention to the bottom right-hand corner, I'm just going to update our analysis here from 7 years. I want to go ahead and take that out to 20 years, and we will update that here on the system. It will update and it'll turn to 20 years right there. Okay. So, right out of the gate, you can see here that FHA at 3.5% down ends up being the most expensive loan option out there for you, closely followed by the conventional 3% down. And then, of course, the 5% down, you can see a real difference there of $22,000 in mortgage insurance and interest paid, even though that interest is slightly higher at 5.125. So you end up actually paying less, even though the interest rate is slightly higher with the conventional, with a 700 credit score. Now at 5% down with a 740 credit score with the same interest rate, it's a big difference, right? It's $40,000 difference after 20 years. So, after 30 years, you're compounding that. Let's take a look at what that might look after 30 years. Well, there you go. You've got a range from $341,000 in total MI in interest versus $273,000 for, a best case scenario, obviously, with the 740 credit score. But Again, guys, that's a big difference, right? Even at a 720 credit score, or a 700 credit score rather, with 5% down, you're talking $45,000 difference in the amount of interest and mortgage insurance that you would pay over a 30-year period of time. So definitely keep that in mind when you're kind of putting these options together and thinking about which way to go, because ultimately your credit score and the amount of money that you put down is going to define and determine how much you pay in interest and mortgage insurance over the life of the loan. Hope this helps. Thanks so much for watching. We'll talk to you soon. Take care.